Good evening and welcome to yet another edition of Bond Squad After Hours. My name is Tom Byrne, the host of the show. Let's get our disclaimers out of the way. Investment advisory service is offered through Private Advisor Group. Private Advisor Group is a separate entity to WS&M LLC and Bond Squad. And well, good evening. I wish I could have been smoother with that intro. But news is breaking as we were going on air out of the Eurozone. Apparently, ECB President Draghi is getting some pushback from sovereign central banks and sovereign parliaments, for that matter. News broke today, or it leaked out of the ECB that the size of the asset purchases was going to be somewhere around just over 1 trillion euros. So what leaked out, and it turns out that the source of the leak was Mario Draghi himself, president of the ECB. The way it was supposed to work is that the ECB would buy 50 billion euros of assets each month starting March, ending in December of 2016. So do the math, it's just over 1 trillion. The problem is the ECB does not have a balance sheet of its own, so to speak. What it would need to do is have the sovereign central bank, so the Bundesbank, the Austrian central bank, the Dutch central bank, and whatnot, do its buying for them. And Mr. Draghi's plan was to have risk sharing. So in other words, the Dutch central bank would buy Italian bonds. The German central bank would buy Portuguese bonds. So they'd be on the hook for this. And you kind of redistribute the risk. So we're all in this together, right? So we have, so the risk from Italy is shared with Germany. The risk from Spain is shared with Austria, so on and so forth. So you're putting basically a lot of risk or potential risk on the citizens, on the taxpayers of these various nations. Parliaments don't usually like that, especially when there's no reform required in these other economies. So basically, there's no strings attached to this. So the ECB would say we're buying 50 billion a month, and Germany would buy its share, Netherlands by its share. Now Germany being by far, well, not by far, but bigger than Austria or the Netherlands, being the larger economy, would have more reserves with which to buy foreign sovereign debt. So basically, the German taxpayers would be on the hook for any missteps done on the periphery. That's getting a pushback. It's getting a pushback in Germany, Netherlands, Austria, even Ireland. Earlier in the week, pushed back a little bit against that idea, with their central bank president Noonan saying that central banks buying sovereign debt would probably be ineffectual at this time. And that presents a problem, because what would ECB accomplish? Immediately people think that, well, it worked here. Yeah, it worked here because there were consumers and businesses which could use the cheap financing. Now, some of it may have caused an overinflated situation in energy, but animal spirits took over, rightly or wrongly, and did something with that cheap leverage. It's not going to happen in Europe quite so easily. They're not drilling. They're not fracking. There's very little innovation as far as new businesses coming online. It's we went over this in previous broadcasts. You have Daimler, BMW, Krupp, Siemens. They've been there for a long time. There's very little new business entry. So what could QE do? It could weaken the currency. It could weaken. It could lower interest rates by weakening the currency. It can make European exports more attractive. It can make domestic labor cheaper, because remember, you're paying them in a devalued currency. Lower interest rates can make borrowing cheaper. The problem is that one of the things that the ECB planned on doing was to buy European mortgage-backed securities. The problem is that MBS is not a big market over there. Even though the EMU's population is similar to the U.S., it's mortgage-backed securities are not the prime way of securitizing, or I guess securitizing mortgages. The way it's done in Europe more often than not is through a covered bond or a fond brief, and this would be issued by a bank, and it'd be backed by a specific pool of loans, of mortgages. Unlike a mortgage-backed security where the investor is only backed by the loans, not by the issuing bank. If it's an agency, it's backed by the agency, some effective guarantee. But in a fond brief, the bond is an actual corporate bond of the bank, same as any other obligation, senior obligation that the bank would issue. Securitizing on the back end is a pool of mortgages. So you have that pool of mortgages backing you. So that has not been mentioned as part of the asset purchase program. So the pool, if you will, and don't get confused because there are mortgage pools, but the amount of outstanding mortgage-backed securities in Europe is relatively small given the size of its economy. So it can't do much there. It could buy German treasuries, but German treasury at 48 basis points. Probably not going to lower those yields much more. You can buy Italian, Spanish, and Portuguese treasuries. Their yields are low, but would you want to own them? If you're in Germany, would you want to put your taxpayers at risk, especially if they don't do any meaningful reform? So that's the pushback coming. And we think at Bond Squad, and me personally, that maybe Mr. Draghi set the bar a little high. And by that we mean he purposely asked for a pie in the sky outcome. We want to buy $1 trillion euros worth of bonds, and we want risk sharing throughout the EMU, knowing that he's not going to get that, but it gives him a place in which to bargain down. So could we see $1 trillion tomorrow when he announces at 8:30 our time? Possibly. Will there be revenue sharing? Not revenue, risk sharing rather? Possibly. Do we think it goes as according to his plans, his initial proposal, his leak, as it were? No. I don't think we're going to see the Germans, the Dutch, the Austrians, the Finns, even the Irish jump on board as is. There's going to be some negotiation, most likely, where it's less than $1 trillion, or if it's $1 trillion, it doesn't have full risk sharing. I mean, why would you do it? Let's compare this to the United States. Excuse me. This would be like asking Texas to help bail out Illinois instead of the U.S. government doing it. We're going to have the states do it. So Texas would go buy Illinois bonds with its taxpayers' money. And Illinois would not have to do any reforms. But for the good of the country, the good of the system, Texas is going to do that. That would not fly. It's not flying in Germany, Netherlands, Austria, Ireland, probably Finland at this point. So we don't think it goes through as Mr. Draghi is stating. Any type of QE would probably be good for risk assets. By good means maybe the asset values go up, maybe they hold in, they rallied a lot over in Europe, even in the United States. But we don't know exactly, and I don't think anybody really knows how much has already been built in, how much of possible QE and how much QE was built into current asset prices. So it's going to be interesting tomorrow to see what happens. The U.S. Treasury's kind of backed off. It's at 186 in overseas trading when we last checked before coming on the air. It was 178 early this morning, and it's been trending higher ever since. You would think that if QE was coming and he was going to push down, and Draghi was going to push down European interest rates, that you'd see rates coming down, because he's going to buy treasuries, and that over there push their yields down even more, and money would come over to the U.S. What could be happening is that they're just taking money out of treasuries and going play in the credit markets. That's a possibility. But if investors or market participants believe that simply crushing long-term interest rates or pushing the euro down even farther is going to generate economic growth, they're probably sadly mistaken. I mean, think of what's happened in the last 7 months. The euro has dropped from over $1.39 to $1.15. So it take back in June, if you had to spend $1.39, convert $1.39 to get €1, and now it's just $1.15. You have had the German 10-year coming down for the last year. Now it's 48 basis points. You have Spanish and Italian yields below 2% on the 10-year area of the curve. It hasn't done anything to spur growth. You've had more than half a year of basically QE or the effects of QE. You've had the low rates. You've had the devalued currency, and yet inflation in the eurozone ticked in at negative 0.2%. Growth was GDP for the EMU as a whole was 0.8, and it's been sliding. It hasn't done anything. Why would this do anything? The problem is there's nothing for Europeans to really use this cheap financing to do. Now, the weakened currency will make profits better for Volkswagen, Daimler, Siemens, BMW, Audi. Yeah, they'll make more money. They can either hold their prices firm, or they can lower their prices, let their prices slide, and hopefully sell more vehicles and increase their revenue. But will it increase much hiring? Probably not. There's enough capacity to do it. And they build a lot of their cars, especially their more price-sensitive cars, in foreign markets where labor is cheaper. You have Volkswagen plants in not only in the United States, but you have them in South America, in the old Eastern Bloc countries, new members of the Eurozone. So, and a lot of those countries still aren't on the euro. So, you probably don't get that much of an increase from that. Yep, Greece can sell olives more cheaply or more competitively, and Italy can export olive oil more cheaply and whatnot. But the biggest advantage would be intra EMU commerce. That's where the big benefit would be. But that doesn't get helped because everybody's on the same currency, and that's the problem. Greece, Portugal, Spain, Italy can't devalue against the other European countries. They're being devalued against the dollar. They're being devalued against the pound. It doesn't really help much. So we created a top 10 list of why ECB probably won't spur economic growth in the Eurozone. So we'll start with number 10, and apologies to Dave Letterman. Reason number 10 why QE probably won't help economic growth in the Eurozone. Number 10, the sale of adult diapers is catching up to the sales of baby diapers. They have a population problem. If not for Middle Eastern immigration, there would be population stagnation, if not contraction, at this point. Another one. This is a little snide. The ECB staff is on holiday. Basically, things move very slowly over there. People get 12 weeks off. They get all kinds of medical leave, family leave. So you can implement this, but how fast it works its way through the economy is questionable. Another number 8. Why finance a business startup when government benefits are nearly limitless? Well, think about this. Why are you incentivized to start a business? Take the risk. If I have a job, I can have it for life. If I don't have a job, I have benefits. So I'm going to go out and deal with the red tape for the different governments, let them decide if my business is a benefit or a negative for the economy as a whole. No, QE is going to be very limited in its ability to spur business and job creation. Number 7, you don't need a low interest loan to fund afternoons at the cafe. Europeans, for the most part, don't make the same type of big ticket purchases we do with leverage. The housing market is much different. The idea of a McMansion is not a European value. Gasoline, even though it's cheaper now than it was, is more expensive here. Small cars are more popular. So they don't. They may love to have a Mercedes, but that's not one of the aspirational goals. And they're not. Very few Europeans are going to say, "Well, gee, I can borrow at really low rates. Let me trade in the Volkswagen Polo, and get a 5 Series BMW." It's probably not on their goal. So when the desire to use credit is limited, the benefits from cheap credit are also limited. And so we go, and we'll go to number 6, which is what I said before. Rates are already low. You have 48 basis points on the German 10-year. Borrowing costs are extremely cheap. The problem isn't the cost of money; it's the desire to borrow money, and it's just not there. There's not a pressing reason to do this. And number 5, the currency is already weak. You're seeing it's at $1.15 now. Maybe it goes to parity. But it's really difficult to devalue your way out, especially when you have to import your energy. Now, oil prices are down, but when you devalue your currency, you start to diminish that benefit. If you have to import food, or electronics or whatever, that becomes more expensive. So it helps the consumer in one way, it hurts it in another. It's not the panacea. It won't spur job growth because labor costs are already too high. All right, maybe not too high, but they're high enough where I doubt you're going to see many European companies with operations overseas bring them back home because of QE. It's not going to have that same benefit it had to the U.S. Remember, the European economy is much more similar to the Japanese economy than it is to the U.S. economy. All right, and we've seen what 20 years or so of Japanese extremely accommodative monetary policy without structural reforms has accomplished. Very little. The best the ECB probably does here is stop deflation. Number 3, rates and sovereign debt yields have plunged for more than 6 months, and the economy is still moribund. Again, as we said, the QE has already happened in effect. The goal of QE is to lower rates, to devalue the currency a bit. It's already happened. Maybe it's too early. It's only 7 months or so since it's been falling. But when you consider they got a tailwind from lower energy prices too, and a recovering U.S. economy, and they still can't get out of their own way, the problems are deep and structural. Look, today, former Treasury Secretary Larry Summers, not known as a hardcore right winger by any means, he was a Clinton appointee, said on CNBC, the ECB's problems are macroeconomic, they're structural. Monetary policy is a cyclical tool. Central banks can bring demand forward when they lower rates, theoretically, or they can push demand out when they raise rates. They can't make consumers who have no desire to start a business, to finance a big ticket item, to change their values, to change their thinking, and go ahead and do that. Remember, foreign consumers don't necessarily want to be Americans. They want to be the best, best Europeans, best Japanese, best Indians, and they each have their own culture. So their goals, objectives, risk tolerance, sounds like investors, right? There's a reason they're human beings. They differ. So just as no two investments or no two clients should have the same investment portfolio, no two economies are going to respond or even benefit from the same monetary policies. So, and number 2, we go back to fiscal policy, divergent fiscal policies. You have governments and economies that are 180 degrees apart. What is similar about the German economy and the Spanish economy? or the Dutch economy and the Italian economy. They have different statistics, different industries, different policies, different rules, different regulations. Yet you're trying to get one monetary policy to fit all. Well, in the case of the Eurozone, which is not a United States of Europe, it's more of a Confederate States of Europe, and that there is no central government making fiscal and trade policy. One size is not going to fit all those economies. So you can have rates near zero. You can have extremely accommodative fiscal policy. And sure, the German businesses will go ahead and they'll export like crazy. And the big multinationals will make money. And the rest of the economies will, the ones with the more cottage industry, with the local industries, are going to probably not reap many benefits on this. And the last one, the biggest reason why ECB QE probably won't do much to spur economic growth is the French. Now, I know people are probably laughing up. He's picking on the French again. And I'm really not. There's an economic reason why the French might be the biggest problem. The France is the second largest economy in the Eurozone, but it's run very much like a periphery economy. So if you had to compare the French to the next most similar economy in the way the rules and regulations are structured, it wouldn't be Germany. It wouldn't be the Netherlands. It'd probably be Italy or maybe Spain. Right? So what you have is a big peripheral country with a lot of clout because of the size of its economy. And because of the size of its economy, it can kind of get by. But it really is a big peripheral economy. Its biggest immigration sources from the Middle East. These people have not been integrated into society or integrated into the job market. Youth unemployment in France is over 20%. People get jobs over there, they don't leave. And without business creation or perpetual infrastructure projects, you can't employ young people. Most people who immigrate to France are fairly young, right? So, and they don't get hired, and they become irate, and sometimes they become violent. I'm not excusing anything, but that's just a fact. All right? So France could be the key. If France would wake up one day and say, you know what, we have to make structural changes. We're going to liberalize the economy. We're going to open up. We're going to reduce protections. We're going to lower business taxes. We're going to cut the red tape. You know, when the second largest economy in the Eurozone does that, you'll see growth pick up, and it would drag other economies along in its wake. But the French are almost like the way the Chinese were to North Vietnam and North Korea, and so they go ahead and they know that the periphery behaves badly as far as its fiscal affairs, but at the same time, because it is fiscally, I don't want to say irresponsible, but fiscally inefficient, it protects these peripheral countries from major structural economic changes. So I really think France is the key to this. The day that France moves its policies more to what core Europe does, to Germany, the Netherlands, Austria, Finland, is the day that the Eurozone starts to reap the benefits from QE and becomes a more productive economy. I don't see that happening anytime soon. There's no reason for most French people to do that. Yeah, it's not in their best interest. They like their lifestyle and they're going, and I'm not knocking it. It's just a fact of life. So that's where we see the Eurozone going. QE would probably happen tomorrow. It'll be announced at 8:30 our time. It could be €1 trillion, could be a little less. Risk sharing seems a little unlikely at this point. But we don't think it adds much growth, if any growth, to the European economy. We still see rates holding very low. If the ECB and or the member central banks are buying foreign debt, sovereign debt rather, that's going to hold interest rates down. It's going to hold our interest rates fairly low. I don't think anything changes on that front. You know, we entered this year with our year-end target for the 10-year note around 2.5. It's going to be hard pressed to get above 2.25, I think. With the curve flattening, eventually probably in 17 or 18, somewhere in the twos. We spoke with a representative of PIMCO today. PIMCO is saying very similar things, that the peak Fed funds rate would be somewhere between 2.25 and 2.75. Well, what does that get you? If the curve flattens eventually, as it does at the end of almost every interest rate cycle, that's got to give you that flatter inverted curve in the twos, right? So we are duration positive at this point, but not to the very long end of the curve. You can pick up about 3/4 of the slope of the curve or 70% of the slope of the curve within the first 10 years. If I can pick up 3/4 of the return going out 10 years versus the 30-year, and I can incur half the duration volatility, 10 years has half the duration volatility of a 30-year on average. On a risk to reward basis, there's no reason to extend out. You could say, well, but look at the yield you're getting, and long-term rates are probably not going to pop anytime soon. Surprises happen. Look at oil. How many people back in June predicted oil was going to go down to 46 at one point, or 46 and change? No one. Now, 110 seemed a little high even to we bond people, but we were thinking, all right, maybe it goes to 90 or 80, 75. The demand growth surprised to the upside, surprised to the downside, while supply growth surprised to the upside. Now you see China growing at 7.3% in the last quarter, 7.4 for last year. It's probably going to keep slowing. It turns out that China's maturing faster than everybody thought. Good article in the journal today about that. This is probably permanent. You cannot build infrastructure forever. You run out of infrastructure projects. The consumer class there, once they bought all the Gucci handbags and flat screen TVs and Audis, after a while it becomes old hat, right? Like, all right, we did that. I don't need to buy a new car every year. The cities are polluted. It's a hassle owning a car, right? It has to be repaired. It gets damaged. So things settle down. And China, even if it's healthy, should continue to slow. It's a developing, but well along in its path, but a developing economy. As economies develop, the rate of growth, the pace of growth slows. It settles in. It could settle at 3, 4, 5. We don't know, but it's probably not going to keep running at 7. The projections made a few years ago by experts who promised investors, China, they have a long way to go before they catch up with the United States, or even come anywhere close. They can go double digits for decades. No, that was not going to happen. It was very unlikely. The Chinese would have to really open up their economy and become more like Americans. They don't want to be. If you want to be Americans, they try to come here, right? They want to be good Chinese. They want to live a good life. We might not think it's right for us, the political system there, the economic system there, but they're going to do the best they can within the system they have or the system they like. All right, so what if China grows at 4, 5, 6, or even 7? Right? We keep hearing comments that people would kill in the United States or in Europe to have growth around 7. The problem is not that growth's around 7. The problem is that asset prices were built in for growth around 8 or 9. So it's like when you bet on a football game and the spread is 6 points, and you bet on the winning team, but the winning team only wins by 3 points. Well, you lose the bet. You can't say, yeah, but they still won. Give me my money. No, it was you priced in a bigger victory. Asset prices, oil prices, commodity prices were pricing in more rapid growth than what we're probably going to get from China, and they were pricing in less robust supply growth than what we've got. So, that's the story with China, but it has its effect on oil. Now, the question we've been asked is oil at a bottom. We're not oil traders. All right. It seems like it's trying to find a bottom. It's kind of stuck here, 46, 47. Could it go lower? Yeah. But logic tells you that it probably has more upside risk or upside potential than downside risk, depending on which way you're betting on it. one man's risk is another man's reward. But 100 seems out of the question. So could we see 30? Sure. But we could see 50, 60, 70. That might be where we settle in. So does that mean that there are opportunities in the high yield market now where with 17% of it or so is made up by these oil companies? Yeah, we're finding some opportunities for aggressive accounts, for aggressive clients. We look for companies with decent hedges, but more importantly, low amounts of leverage, because as we've seen, even with interest rates coming down, benchmark rates, corporate credit spreads have widened out. It's even with the 10-year down below 2%, we're seeing junk rated corporations pay a full point more than they did last year for financing. So they've gone in the opposite directions, right? This is bad news for the weakest borrowers. If you have a lot of leverage and you have to refinance it, you're going to have a hard time doing it. And the cost of borrow goes up. So we're looking for low leverage companies. They probably overdid this sector. There'll be some turning off the spigots. We saw 55 rigs were shut down last week alone in the U.S. Right? That probably keeps going for a while, and then production will slow. Oil prices will rise. Maybe by the summer we'll be at 55 or 60 on oil. Right. What does that do? Well, that takes some of the edge off the benefit that consumers are supposed to get. It probably staves off execution of some of the high yield oil drillers and exploration companies. The ones that'll survive more easily would be the ones with less leverage, but there's still risk out there. So it's kind of the answer is probably somewhere in the middle. The problem we have is that people keep looking to OPEC. So an OPEC minister today saying oil prices are going to rise. All right. Bond Squad's opinion is that OPEC is no longer the swing producer. OPEC is not the producer that sets the global price of oil. North America is the swing producer. Let oil prices rise a bit. You put crude back in the 60s, you'll see the wells turn on, exploration start in the United States, at least to some degree, right? And then oil stays there, maybe comes down a bit. If OPEC cut production, more wells go on in North America. And then refineries start changing. Right now, refineries are not set up to refine the very light, sweet crude that we have in the U.S. into fuel. If we're producing more, they're going to be incentivized to do that, to convert their refineries. So we think that maybe oil is near a bottom. Maybe the worst is over for some of these oil companies. Maybe they haven't shown the full effect of this either. And oil probably starts to move back up later in the year, but probably not anywhere near where it had been. It probably doesn't rise enough to ward off many of the junk, the deepest junk, the CCC type loan and bond defaults out there. What concerns us is if this was supposed to be short-lived, we probably wouldn't see all the layoffs announced. We're seeing every day layoffs in the oil sector. You see home builders CEOs saying that they have a much bleaker outlook on construction because they were relying on the oil producing areas of the country for new home starts. So it's a little unnerving. So this tells us either one of two things: that oil company CEOs think that lower oil, maybe not this low, but lower oil prices are more structural than a temporary cyclical situation, and or the balance sheets aren't strong enough to ride out a temporary hiccup in oil prices. So either way, when you're looking to invest money in oil, and we've heard fixed income expert after fixed income expert say, now's the time. You cannot, and I repeat, cannot go in and just buy a portfolio, a product featuring oil debt. You need to be choosy. You need to have someone who can be choosy. So, it's not a one-size-fits-all world. And look at the volatility we're having. It's not the same market we had in the last 5 years, last 4 years. It's just not the same market, and many investors and even more traders don't remember what it was like before the last 5 years. A lot of kids working for a lot of portfolio managers and money management firms who didn't experience the bubble and the correction in 2008. They have no idea. But that's all we have for this evening. It was kind of low key tonight. We're sitting by the fire in our lodge in the snowy Pocono Mountains. If you look closely at the window behind me, you might see some snowflakes coming down outside. It's a very cozy feeling here. We're resting up, getting ready for the volatility and turmoil following tomorrow's ECB policy announcement. We ran a little long tonight. Not too bad, by about 6 minutes. That's all we have. Please, any questions and comments, you can contact us directly. We have if you can see it, our contact information. We can be called during market hours at 570-424-1555. Our email is thomas.byrne@wsnm.com. And we are available during market hours. And we want to make a little public service announcement. One of our colleagues at Private Advisor Group, who's our RIA, and they handle they do all the legwork for us for our SMA business, all the compliance, all the regulatory business. Well, one of our colleagues over there, John Hyland, is battling cancer for a second time, and he's in need of a bone marrow transplant. And so we're looking for donors. I don't know if you could see the information here. The web address here, if you can't read it, is it's at privateadvisorgroup.com, SWAB for life, SWAB for life. We're looking for donors. John is a good guy. Private Advisor Group has always done right by Bond Squad, John included, and we would like our viewers, our readers, our subscribers to go to the site and possibly see if they're a match. This is something that would be very much appreciated by Bond Squad. And that's all we have tonight. Keep John in your prayers, and more importantly, try to help him. He's a really good guy, and it would mean a lot to us. Thank you, and have a good night.